Okay, everyone, welcome to our third episode of DLT Fridays. Today, Gordon and I are going to be talking about with a really interesting group, talking about DeFi and how to bring crypto interest rates and yields to the masses. Okay, everyone, welcome to our third episode of DLT Fridays. Today, Gordon and I are interest rates and yields talking about with a really interesting group talking about DeFi and how to bring crypto.
There's two of him.
I can't handle two Jameses. That's a bit much.
To our third episode of DLT Fridays. I think we're in a loop. Today, Gordon. Sorry, guys.
By the way, James, I think it's show number 2.
Exactly. Just with a really interesting group. This is number 3.
So one,
DeFi and how to bring crypto.
Someone's probably streaming it as well as being on Zoom.
Does anyone have YouTube open besides me?
Nope.
Episode of DLT Fridays. I think we're in a loop. Today, who's Mark Moore? Sorry, guys.
By the way, James, I think it's show number 2.
Exactly. Just with a really interesting group. This is number 3.
So one,
DeFi and how to bring crypto. I don't know.
Someone's probably streaming it as well as being on Zoom.
Does anyone have YouTube open besides me?
No. Nope.
DLT Fridays. I think we're in a loop. Today, who's Mark Moore? Sorry, guys.
By the way, James, I think it's show number 2.
Exactly.
But we do kind of see DeFi as being part of the portfolio in the next year, at the very least. Yeah.
And Tim?
Hey, James. Yeah, thanks again for having me. I'm in Thailand today.
Sorry about the technical, the illustration of my technical.
James, I think it's show number 2. That's not me saying this. This is not me.
Okay.
And by the way, you're right. It is show number 3. Sorry, senior moment.
Yes.
My bad. But what time is it in Thailand? That's what I would like to know.
It's 9 p.m. So
okay,
perfect.
Very good. Nice.
So just wrapping up kind of a busy week. So yeah, on my kind of just overall interest in DeFi, I've been kind of a fintech blockchain entrepreneur since 2014. Kind of early stage growth in fintech companies. Help bring a lot of kind of big crypto companies to market, kind of early adoption, early growth, before setting out and then yield this kind of my newest venture. And it's always been kind of a mission of mine of just bringing more people to crypto. I mean, I'm not a developer. I'm not one of these guys who's going to change the world in like a Vitalik character. But I been quite successful kind of working with great entrepreneurs and helping bringing great products to market. I see DeFi as like a natural bridge and something very, very sustainable, like a very sustainable kind of ecosystem moving forward. It's very chaotic, but I feel like it's a very clear, large part of like the future economy. So that's kind of our kind of passion on the side.
Very nice.
You're on mute, James.
Toby?
Yeah, no. So yeah, James, I'm super excited about DeFi generally, just because I think it's ironing out a lot of the major problems in crypto. So I think sort of having been in the space for 5 years or so, what got me quite excited about DeFi initially, I think, was just the concept of the decentralized exchange, right? Because I think it was very, very clear in 2017, 2018 that the centralized exchange were taking up a lot of the value of projects and new ideas being built. And I think that DeFi, by just allowing anyone to sort of spin up an idea and work with a decentralized exchange, brought a bit more of the free-flowing behavior that I think you should be seeing in a fun, alternative, interesting market.
Cool. And so
I might make a comment there, James. Is that cool? I think that's a really good point, Toby, just to kick off, man. So, I kind of see DeFi as like the next phase post-DEX, right? So the decentralized exchanges, we had issues with liquidity, still to this day, you know. To me, what really interests our firm and our partners here is the fact that you can align in incentives, right, with these new decentralized liquidity models. And, you know, obviously Uniswap is one of the best examples to date, but to me, that's the most exciting thing that's happening now. It's aligned incentives with few intermediaries to hassle everybody.
Well, let's talk about where we are today now. It's Toby, your firm just came out with a DeFi calculator, which was really cool. It shows like historically how you would have done in different pairs on different platforms. Talk to us, what's really happening right now? You know, I see people talking about making 1,000% a day, you know, and then I see other people saying, I can't figure out, I lost all my money. You know, what's interesting to me is that some stuff you see and you just know it's not sustainable, whatever it is, you know, it's just not sustainable, even if they're getting what they're saying they're getting. And other people, you know, are participating and just not understanding what they're doing and just pressing buttons and essentially getting random output. So what is the state of the market?
Yeah, no, I guess we probably this year was slightly the Ponzi phase of the market, right? So you had
a lot of oxymoron. The slightly Ponzi phase, isn't the nature of a Ponzi phase that it just needs to keep on rolling?
Well,
I mean, that's very kind. It was slightly Ponzi.
I would say slightly. The qualification is like a lot of these projects started off at Ponzi's as Ponzi is effectively just an idea going, this is going to be really, really cool, shove a load of marketing behind it, and then gradually pivoted into something that's beginning to look real, right? So it's more, that was maybe a bit unfair, but to James's point, the idea that you could make a 10x, 12x, and I think that's still going to happen on a lot of these projects, right? As one of my trader friends was saying, it's basically like your typical crypto trader is working on Ponzi logic, sadly. I think what's exciting about DeFi is it's fueling some of that behavior, and then at the same time, I think Tim's going to talk quite a lot about some of the sort of rational behaviors that you can bring in. But I think
actually, let me ask you a question, and this is really for everyone. Yeah. One of my favorite expressions is explain it to me like I'm 5. So here's a question I want you to explain to me like I'm 5. It seems to me that in every deal there's a party and a counterparty, and I don't see wealth. I can understand why Bitcoin goes up because new money is flowing into the market, but with DeFi, I presume, as with regular finance, there's counterparties involved, and since no new wealth is being created, where are those returns coming from? Or do I need to reframe how I understand this? So again, explain to me like I'm 5.
Well, yeah, I can.
And I was like 1,000% from whom? Is kind of the question. Or from what?
So, well, it's a market. So I think there's, to a certain extent, there's value being created in a lot of these things because more people are believing there's future value in it, right? So I wouldn't say it's a zero-sum game as a market, right? Because as long as these things do something, then that becomes positive. But what my essential point in terms of, and I guess I used a slightly inflammatory term there, but but rightly so as well, because I think there was a lot of...
Well, sorry, maybe it wasn't inflammatory. You know, again, from the explain to me like on 5 perspective, where is that 1,000% coming from?
Yeah.
Maybe it's not inflammatory. Maybe you're right. So explain.
I think a good example would be YFI, right? Which I think is quite an exciting project and quite interesting. But a lot of what it was billed as was this black box that you can point anything at and it can create yield for users, right? So the whole market went, sign me up, and sort of a marketing machine went around it. It already sort of, everyone should have had their sort of warning signals up, or given the characteristics of of it sort of following a sort of classic pump and dump behavior. And so I think that is what has characterized the DeFi space, is often a lot of hype, and then there's a kernel of positive things that are coming out of it. And so the way I'd say the different value being given to these individual projects, to a certain extent, the project is capturing a lot of that value, and then the early investors more of it. And then you're beginning to see the actual behaviors that then people like Jonathan or other new groups coming in can then go, how do we build interesting tools out of that? So if you go to YFI or Yearn Finance's website now, you can then see a whole host of sort of different yield products that you can see the sort of return that you might get from that.
And let me throw it to other panelists. Again, explain to me, like on 5, where's the money? Is there value added that's in any way commensurate with that 1,000% return? Or is that, is that almost like a separate topic?
Yeah, I mean, okay, that's one area of DeFi. I mean, to kind of step in, I mean, yeah, there was the early people in YFI made 1,000% return, and of course it is a good product, and it's a tremendous ecosystem what's been built on that. But I'll personally say, I mean, my personal belief, no, I don't see any of these as sustainable. I mean, any time that you see innovation popping around, especially crypto, and YFI is a good example, then there's 30, 50 clones that are going to be popping up. So I mean, on a personal level, our kind of company philosophy, we have nothing to do with these types of projects. We don't see these as sustainable, these things that are clones and popping up overnight. But I think this is just only one small segment. It's what kind of really brings in a lot of people, right? Is these fast big returns, right? The 10x's, but this is not. I mean, 10x is never sustainable. I mean, it's gonna end up hurting someone.
Let me break in. So I'm clear. That 10x, I haven't heard a good argument yet about how that 10x is coming from new value creation. All I've heard is that it's coming from other counterparties. Am I wrong?
So I mean, I'm not going to back up these 10x returns. I mean, period. I mean, YFI. I mean, maybe is maybe a good example for those looking to kind of validate that. But overall, I mean, just what we're looking at is more sustainable returns, because overall, I mean, we're looking to offer our clients like a very sustainable, long-term, multi-year kind of returns, right? And this is all kind of spurned off of this whole DeFi movement, but I don't the 10x returns is more of a return to like this.
Let's get off the 10x returns. The 10x returns was a straw man, guys. We don't want to spend the whole time talking about the 10x returns. Let's talk about more like, so those 10x returns, a lot of them are coming from earning these governance tokens. That was a new concept that were shooting up in value because of unrealistic expectations or maybe too quick expectations of what the value of voting would be, even though there was no voting rights attached to those things yet. And so, but let's talk about, so that showed that people want yield, they're willing to put risk, right? So Tim, you and John, you guys see that and you start to develop platforms. What's the problem in the existing setup in terms of opacity, in terms of sustainability or scalability? What's the problem in that system that you're trying, that you see needs to be fixed? And how does it get fixed so this turns into a regularized and normalized market? John?
Yeah, look, firstly, I think one of the problems at the moment is that these tokens have been created out of thin air, very much like the kind of ICO boom, right? But at the foundational level, the technology is brilliant, right? Because it's aligning incentives within liquidity. My background's prop trading in the FX space. I was a prop desk trader for a while up in Sydney, ran a little prop fund. And if you look at FX liquidity, which is a really interesting OTC market, you've got all these disparate LPs that recycle, liquidity providers that recycle this liquidity. The takers pay The market makers all have to be fairly aggressive, and it's basically a battle between people taking liquidity and the firms that are actually making that liquidity. Decentralized finance aligns incentives. So the market makers, which is you and I, putting liquidity on these exchanges, putting up Tether, putting up USDC, putting up DAI, they're getting paid to put that there, right? So it's true peer-to-peer connection points. The people taking are getting cost efficiency, price efficiency, because the pool of capital that's sitting there is great, right? And that depth is increasing every day. So to me, it's less about the annualized returns that spike at the beginning of this, which is very much a function of risk premium. You know, you take the risk early on, you earn these kind of annualized returns, but they're not going to last an entire year. And it's more a function of the foundation. It's more value in the actual foundational technology. So that's where I think the value is. And I think that's going to ultimately change everything from the way we transfer funds to each other to the way we bid on sites like eBay. You know, it's going to be fully aligned in incentive models throughout finance is the way we see it.
And Tim, how do you see people wanting to participate? If we're going to get beyond the heavy crypto trader that's going to spend time trying to chase yields, you know, from site to site, how do you see this evolving into something more permanent?
Again, I think it's just way too complex, and you know, there's too many bad actors in the space. I mean, I think there has to be more kind of bridges. I mean, there's all sorts of different level of traders, right? You have the DeFi chat group, right? And you know, these hardcore developers, which are like they're shaping it, they're innovating.
I'm sorry, I got to break it. Did you say DeFi Chad?
Yes. Yeah.
I love that. That was the money quote right there. Okay, please continue. But that was beautiful.
I mean, part of the show is we're supposed to be terms for, you know, coining terms for the future. So just put that on the list. Put that on the list, Gordon. Put that on the list.
Yeah. Yes, sir.
I can't take credit for that one, but so I mean, there's all sorts of these different levels, right? We have, you know, the hardcores, the people that can follow them, the more the novice, and then get to a point where, you know, the people who have day jobs that don't have time all day to sit in Telegram groups and find out everything that's happening and be monitoring their pools all day. And then there are these layers that are being developed, all these tools where people can actually kind of be able to invest, you know, and diversify investments, you know, and you know, we're particularly going after a very kind of more retail class, right, of people that really, they don't need to know how to DeFi, like, and so I mean, I think there's all these layers, but if we're going to let more people are going to be moving into this space, there has to be, I mean, there has to be checks and balances, because I mean, they can only have a few. I mean, someone has one opportunity. If they get wrecked or they get rug pulled one time, like that's their DeFi experience, that's their crypto experience, and that doesn't help anyone but the malicious actor on the other end. I mean, the self-governance, this space has always been, I think, it reacts, but it's always a bit slow to react, you know, and it's just always too fast, kind of either way. So, you know, more self-governance. I think in the last run in 2017, we saw like the Binances really come up and fill kind of a market need where people could actually get access to kind of crypto, and the Coinbases and all these, you know, great companies in between. And you know, I think for DeFi, again, I think we have kind of a mission. We want people to be participating in DeFi, and you know, they don't even know what a private key is, right? So that is obviously for probably a lot of people on that call, that's not DeFiing, but you know, again, that's giving access to it. There's just multiple layers that we see. It's kind of a natural way of progressing for any kind of financial market.
But is this going to stay DeFi, you know, decentralized, or are we going to end up being like like the internet and all these other search and travel, where you start to travel up to more and more aggregation to the point where you just put something in Google and Google checks everything for you, so it really becomes centralized. So the product is DeFi, but do you think your product, Tim and Jon, is your product really DeFi, or are you actually centralizing to create a better experience? So people could benefit somewhat from the DeFi world.
Well,
No.
our product's definitely not DeFi, right? So we take Bitcoin and Ethereum and essentially loan it to counterparties and trade on the futures markets, right? But we talk, a lot to wealth managers and family offices, and they're all very interested in the space. But to Tim's point, at the moment, it's an immature industry, it's nascent, and the technology needs to build liquidity to actually create space for, larger investors to come in and basically own it. Where do we think it's going? Again, we think it's going to be foundational and game changing, but it's quite hard to kind of figure, at the moment where, which part of it is actually going to mature first, whether it's the liquidity on exchanges, whether it's actually, decentralized projects with kind of VC backing, that are changing the way we do business. It could be a whole range of things. So I'm sure Tim and Toby probably have a better take on the kind of projects that are most likely to succeed, in the space now.
And I think it might be helpful to go a bit into the auto market making function, and what I think that I see as the one of the major sort of revolutionary things sitting at the heart of DeFi, right? Where essentially you've got continuous liquidity being put by other users for a market to be created in particular things. And I think that is pretty transformational, because it's firstly allowing, from a user perspective, if you're looking to sort of just, if you're a project, it's very, very good, because you can begin to just ensure that you're getting the right liquidity and you're not so dependent on particular exchanges. Then if you're a user, you have all of the sort of the good functionality that Tim's giving his users and Jonathan, in the way of sort of giving people a decent, fair yield that they can get on sort of perpetuating particular pairs. I think that.
And Toby, does automatic market making also provide a measure of protection against regulatory attack? Because you're getting away from the sort of centralized gateways that governments can attack. I mean, if
yeah, so that is the perceived wisdom in this space, right?
And tell me that's wrong.
So I think I do worry. Like, one of the big things is like, if you look at Uniswap, which is still the biggest decentralized exchange in this market, they're currently sitting in New York. I'm pretty sure they don't have a BIT license, and I think that there's a theory that the regulators might not be able to sort of challenge them and force them to sort of remove the code, right? So the theory is that it's keeping existing and ticking away, but you can certainly imagine that if New York went after the Uniswap developers, it could be quite an uncomfortable time for anyone trading on Uniswap. So I think regulatory risk is hard to avoid. What's quite interesting is then the sort of open source code is out there. That's the sort of crypto anarchist point of view. And they're like, well, it doesn't really matter, man. The regulators can't control it because Uniswap's there. And then they developed Sushi, which was effectively a copy of Uniswap in a slightly millennial, scary way. But that can perpetuate ad infinitum. So the regulatory risk for crypto, in theory, has been removed because the regulators are needing to play whack-a-mole in a way. So there's, but for a specific trade on a specific exchange, there's still regulatory risk. Right?
Just to point out something really cool, I agree with you about the Sushi Swap is this millennial concept of, but they did it. They took forking and they just did what you're supposed to do, which is make the intellectual property available to everyone, and then give people the opportunity to participate. And if you wanted to come up with a multi-billion-dollar exchange, in New York, in the classic banking market, you need years and tens of millions of dollars of overhead and mind-numbing amounts of regulatory compliance to be able to spin it up. Whereas with Sushi Swaps, basically launched in a day, and this new network is working, right? They were able to propagate the news of their existence in a way where it rippled through and drew people and capital on target in a way which is historically unheard of, right? So there's something there. People want it. The regulators are going to try and regulate because, to a guy with a hammer, everything looks like a nail, right? But there's a world out there that wants to participate in transactions and yield and storage and supportive platforms, which is going to be unstoppable with the regulators putting their fingers in the dikes, trying to deal with it. Jon and Tim, how do you deal with the regulatory aspect? Because when I coach people about DeFi and about how to build their platform, what I tell them is you have to either be regulatorily compliant or you need to stay completely decentralized and not have a single point of failure. But you can't go in between into these gray areas where you have a little bit of compliance, but a little bit of DeFi and a little bit of, you can do what you want, and a little bit of you better file your tax form. That doesn't work, because once you have the single point of failure, you're there. It's binary. You're in the regulatory world. So do you look at this as an advantage or a disadvantage, Tim? And how are you building to deal with that issue?
I think you're spot on. I think that you have to go full DeFi, or you need to go as a regulated entity. I mean, we are a licensed and regulated entity, and we're building out a full compliance department. Said we use centralized BitGo wallets. I mean, so we're building essentially a managed fund. And we're approaching this as we want to be licensed and regulated. And on kind of every step of the way. So, putting in checks and balances and trying to do things appropriately and managing this like a managed fund. So we do. I mean, one of our co-founders runs a large legal firm in Thailand. We have other kind of professionals who have built managed funds before, and that is the approach that we're taking. And and we did take that approach from day one, that we are going to go this path, right? And obviously, it does have its own unique challenges. It's overall we see this as let's say a multiple year kind of build out. We know very clearly, like dealing with regulators and going for tier 1 licenses in the future is going to be challenging, but we are going to go into that. We're going to have historical data, and we're going to have all our proper documentation, and we're going to be able to show them ideally everything that we're doing. And if like I said, if someone wants to be fully decentralized, full DeFi, right? They're in the end, they're not our client. Our clients are people who want exposure to this new asset class and want to do it in kind of a safe fashion. So that's kind of where we're aiming to go.
Tim, as I guess I didn't get a chance to mention in the beginning, I'm a lawyer. I specialize in crypto and blockchain. That's how James and I got to collaborate and become friends. When you say you're building out your compliance department over a course of years, is that in some small measure because the requirements to comply are not yet totally clear and you sort of need to evolve as the regulations evolve, or what makes it happen over time?
Well, I mean, we are, from launch. So we're launching December 14th is when we are launching. We have our chain analysis set up. We have, our compliance department, our KYC. So, from day one, we know who our clients are. We know the kind of where the source of funds are coming from. Overall, how we're kind of deploying capital. It's just, I'm talking about going into walking into a Swiss regular office and having that discussion with them. And, what is your product? Well, it's kind of a DeFi portfolio that we're managing. And then obviously that's a lengthy discussion. So, we're seeing this as like, what can we do now to get operative, to try to put in best practices now, and, and just running a clean ship, as we keep building this what we'd like to be
Jon, where do you come out on that?
Sure, man. I mean, look, it's an unregulated asset class in Australia. We are in the middle of getting a wholesale Australian financial services license, and we don't need to, but we're getting it because we do want to front run the regs. And there've been some lessons here in Australia historically. ASIC, our regulator out here, have a habit of releasing a few licenses to newer emerging technologies. Back then, it was FX retail exchanges back in the kind of mid 2000s or 2005, 2006. And then they tend to cut off the licensing, right? And then you just have this pool of licenses that then get recycled through M&A, mergers and acquisitions in the space. So we're front running it for two reasons. One, our wealth managers and family offices are starting to ask more and more for licensing as a form of protection. And two, because we think it'll be really valuable over the next year or two. Just touching on something you spoke about earlier, James, I think is worth mentioning, you know, the fact that sushi can roll up in a day and essentially be exchanging assets is incredible. And I think it's worthy of kind of note here, you know, one of the biggest challenges being a crypto business is banking, right? To send, like we sent a bunch of Aussie dollars today to the States. It had to go through two correspondent banks. You know, we missed the bank because of the Thanksgiving holiday. So it's only going to arrive on Tuesday next week. If we were going to set up infrastructure, the five of us right here on the panel, it would take us decades to set up that kind of banking infrastructure, right? To be able to move those funds. And sushi, you can roll it up in a day and exchange capital, right? And you don't even need staff. It's like sushi, the incentive models are there so that people actually provide deep liquidity on a P2P basis, and you've got a fully fledged exchange. And I think that it's a really good point, because the shortening of time in the space and the adoption curve will be very fast because of what's going on. And I think it won't be long before, you know, these technologies actually being adopted by the larger players. So coming back to regulatory environment, for institutions and family offices to actually use it, they need a regulatory umbrella, and that's very much kind of why we're going down that path.
So really, your decision on compliance really goes with who you want your customer to be. Is that what's happening?
Look, I think it's, like I said, it's twofold. You know, our customers are demanding it more and more, and you know, our purpose as a business is to put a Bitcoin in every portfolio, right? And for most retail,
put a Bitcoin or put Bitcoin?
Put a Bitcoin. You know, that's a market. It's a marketing.
Wait,
it's a marketing.
Do you need my wallet address? Do you need my wallet address? I'll take a Bitcoin in every wallet and a turkey in every oven and a TV in every home. We'll be all set.
Oh my God, you sound like Bernie Sanders.
But you know what I'm saying, right? So most people still do not know how to buy a Bitcoin and custody it. And the only way to adoption really is by getting, you know, here it's superannuation funds, in the States it's 401k, getting the big end of town interested and having wholesale access points, right, through custody and yield and credit products that they can then offer to their retail customers. So that's very much where we're focused.
Interesting. And Toby, what do you right now when you look at you looking at any platforms that are regulated in terms of your DeFi calculator and your analysis of the market?
Well, to date, I mean, we're obviously very interested in the regulated. I mean, the regulatory question is interesting, because I wouldn't say there are that many regulated exchange, like really regulated exchanges in crypto, right? Like the obviously you've got the sort of wider security token market, and Coinbase or whatever is dealing with the regulator, but there's just different grades. But I don't know if you'd really describe even Coinbase as a regulated exchange, right? So I think but anyone, sort of the way the regulators operate is you're performing a function that fits inside all the existing rules and regulations, right? And in Europe there is the MiCA thing, which is has put out various different things around DeFi and that kind of thing. But I think,
can you explain that for me
yeah.
and others?
So they specifically put stuff in the MyKetR rules talking about how if you're offering particular sort of additional tokens for doing a particular thing to incentivize it, there's whole sort of bits of legal verbiage in this horrible document that's terrifying if you read it and you're doing anything in this space. For context, we were in the process of fundraising for a DAO token sale, and we had a term sheet out for like 350K, and the proposed investor was a regulated hedge fund sitting in Europe. And when they saw this big regulated document come out, even before it hit paper, they slightly had cold feet and went, we're going to need to wait and analyze what if this actually gets regulated in the European Union. We're not sure if we want to be playing around until we understand a bit more how it's going to pan out.
It was just 350,000. They wouldn't.
Yeah, they were there. These cowards, right? Like,
Well, it speaks to a psychology of the market, and it speaks to maybe the non-competition friendly or non-innovation friendly nature of some of this legal infrastructure.
Yeah, 100%. So anyway, it was an interesting moment. So I think the regulators will be coming. And probably there will be some regulatory plays next year, because at the end of the day, you can't have a market with $12 billion exchanging hands and all this kind of behavior without the regulators. Like, are they totally asleep?
Well, let me throw you something at you. And James has repeatedly made a point to me, and I've kind of he's right, and I've accepted it as axiom. Once he pointed it out to me, I realized the truth of it, which is once you dip your toe into the regulatory ponds, the pond monster can now grab your entire body and pull you in. It's like you're either totally out or totally in. He repeatedly makes that point, and I think he's right. Actually, now that I've given some time to think about it, does that mean is it going to be sort of like two parallel worlds, maybe like one regulated space and then a mirror image of these products in the unregulated space? You know,
crypto is kind of Napster world, right? In my view, it's like the pirate world, but the pirate world is so kind of exciting that actually the functionality, there's a really interesting thing where a lot of the advantages of this sort of unregulated space are so clearly apparent that you kind of almost want this parallel universe to exist, right?
Well, I'm not against it. I'm just wondering if, you know, I've always been a fan of, like, you know, science fiction or speculative fiction, and there's this idea of like parallel universes, and I can kind of see, and you have your twin self in some other place, and eventually you meet them, you're like, oh my god.
Let's bring this back. Tim, let me cut you off. Tim, let's say that our customer base is family offices who believe, like John and many people do, that I gotta own a Bitcoin. I gotta have some exposure here. I can't be completely out of the market, right? So what does that guy want, and what does he need, right? And then talk. Then, you know, so how's that shaping what you're doing?
Is that a question for me, James?
Question.
Yeah, go ahead.
Both of you guys.
So,
Go ahead.
yeah, man. So we it's interesting, the rationale at the moment that's coming from family offices in particular. We work with Australia's biggest family office, and they've increased their allocation massively over the last kind of 3 or 4 months. They want access, well, they want exposure to a non-sovereign asset, but they want the protections of sovereign assets, right? So it's an interesting kind of situation. Now, they're a very forward-thinking family office, so we've kind of spoken to that through insurances, you know, in the custody side. Our yield products are hyper transparent. They can see all the counterparties, so we're kind of dealing with it in a different way. But ultimately, I think these two things can coexist, right? The regulated and the unregulated space. And I think they will have to coexist because the unregulated, decentralized version of Bitcoin, it's non-sovereign, that can it's transportable over borders, has limited supply. That is a hedge in itself. Like, you're hedging natural exposure with non-sovereign exposure. Then you've got the radicals, and obviously the adopters and the millennials, and, you know, I guess you and I really, who hold it on a hardware wallet. You know, we'd rather, I guess, hold it in an unregulated environment by virtue of not wanting any intermediaries involved. But those two worlds can coexist, and I think they actually add value to each other ultimately.
And Tim, what do you think what does this user base want? You know, and how do you deliver to them?
Yeah, we kind of dealt with this. You know, previously I was part of the Eki Bank team, and we had crypto custody and dealt with family offices and high net worths. And you know, what we found out from dealing with all these, you know, family office events is, well, they do want exposure. At least they're interested in exposure. You know, safe custody. You know, I mean, just more kind of I guess, traditional kind of processes is a lot of what they want to do. Naturally, I think during the bear market, I think they were people more like just looking and following. And I'm sure right now I haven't been dealing with these family offices, but I imagine that they've radically decided to be making moves, at least the last months. If they haven't, they're definitely probably regretting this at the moment. But I think the industry has definitely been matured quite a bit. I mean, you know, Bitcoin is now, you know, 10 now, and it's just continued to, it's to the point I think most people do see it here, and you know, they've seen these peaks and valleys. So, you know, there's more comfort, you know, transparency. They want to know that their assets are ultimately can be safe, right, and kind of hit all these standards and processes. So.
So, I mean, I look at this as that there's a revolution happening in finance, which is DeFi, and the idea of moving away from, you know, own your own bank and, you know, self-custody, and this whole idea of managing yourself directly. And then there's, I think, the world that you guys are in, Tim and Jon. It seems to me like you're actually trying to put a evolutionary wrapper around it, right? So, you know, your money manager, you have bank accounts, you have some hedge funds, you have some online accounts. You kind of haven't fully moved into the 21st century yet. And you know there's this thing happening, and you know you're sick of you're losing money by leaving it in the bank. So, you know, so here's a thing that kind of looks like what you already have. I'll give you some of the protections, and I can approximate, you know, how you're allaying some of the risks and fears. And if you press this button, you get 6% instead of getting negative 0.5%. Is that right?
100%, man. Yeah, totally. So, you know, I mean, yield is a whole topic in itself in terms of, you know, what bond yields in traditional markets are doing. And, you know, it could be argued that the bond trade is pretty much going, it could be dead in a few years, right? If we continue to lose yields, people are already, you know, being forced to kind of invest through institutions into negative yielding bonds for exposure. So, you know, we actually spoke to a financial advisor today who gave us some really interesting insights on index funds as well, right? So retirees that would normally invest in bonds for income, super low risk, are now being forced into index ETFs and the equity markets, right, to earn dividends and basically, you know, they are exposed to delta whilst earning this income, right? So huge volatility risk. They're looking for delta neutral or at least lower risk delta in their portfolios, and they can achieve that in one of two ways, right? They can invest in dollar tether or US dollars and earn 6 or 7% just in the lending markets, right? In the space at the moment. They're exposed to the US dollar, but they're not getting real negative interest rates in that sense. Or two, they can take a very small allocation of Bitcoin, right? Which ultimately improves risk-adjusted returns in their portfolio. there's volatility, but if they're only allocating 3-4% of a portfolio, ultimately the correlation gradients show that it improves overall volatility in the portfolio, plus they can earn credit on it. So this is slowly starting to take hold, you know, and I think where else?
That's a fascinating comment. That's fascinating. They're not buying Bitcoin necessarily because they're like a Bitcoin maximalist. They're doing it because they need to have a balanced portfolio and offset other risk.
Totally. I mean, that's where it's going, right? So our firm's done quite a lot of quant work on this, right? You know, the old Markowitz efficient frontier model. I won't get into it too deeply, but if you look at the volatility of an equity bonds portfolio over the last, 10, 20 years, and you add little bits of Bitcoin, it improves the upside, but decreases the overall volatility in the portfolio, right? And it does that because it is truly one of the most uncorrelated assets that we've seen against equity and bonds as a major asset class. But furthermore,
I had never thought about Bitcoin in the context of balancing other portfolio aspects. That's fascinating.
Totally, man. Yeah, I mean, the other thing we pitch this at the moment that we, some of our quants came up with is this idea of leverage without leverage. You know, normally to increase volatility in a portfolio, in a standard portfolio where you're 100% allocated, you have to go take a margin loan to purchase more stocks, or you have to gain some kind of leverage. Bitcoin, you can add leverage to a portfolio without having to leverage the asset, right? So I can buy 2% of Bitcoin, add it into a portfolio. It's totally unleveraged, but because it's got natural volatility, you're actually getting free leverage in a portfolio. So there's all these kind of really valuable portfolio metrics that are coming out at the moment. And we're really trying to drive the narrative because, that is the value to the everyday person, in my view. And our, in many views.
Right. James?
So Tim, what are your thoughts there?
On which part exactly? Sorry.
The middle bit.
The thing you said before,
let me ask you
that thing.
Let me ask a specific question. It always seems to me as odd. I have my dollar accounts here, which I'm trying to get out of as quickly as possible, and looking at them dwindling and looking at my fees for breathing on each of my bank accounts, and then I see Tether gets 6%, USDC gets 2%. And I'm trying to figure myself, wait a minute, it's supposed to be $1, right? Why is it that this dollar gets me 6% and this dollar gets me negative 0.5%? Can you explain that?
But I mean, no, I think that is I think that's the motivation. I think for probably everyone in this call. I mean, there is a great opportunity. I mean, the yields are real that are being generated. I mean, not chasing these kind of wild returns, but conservative, positive returns is something that we're very comfortable with, and I think the overall crypto market has been very, very comfortable and very sustainable.
Tim, we cut you off. Where's it coming from? Where is that 6% coming from?
I can answer that
Go ahead. Go
Tim,
ahead.
Yeah. So the US.
Wait. I want to see him sweat, John.
Okay.
All right.
The US dollar interest rates are pretty much solely tied up to the futures basis trade, right? So with the launch of the CME futures and the increased derivative activity in the space, BitMEX, FTX calendar futures, the delta neutral basis trade, right, where you're selling the future and you're owning the underlying, is super positive. And it's way more positive than other asset classes because the big boys want to gain future value by buying futures on the CME, so it drives the futures price up. And then the hedge funds want to earn the basis, so they're selling the future. And that leads to this natural interest rate cash and carry trade that's becoming more and more prevalent in the space. Now, with more liquidity, the questions are, will that trade continue? Will the interest rates continue? But there has been a massive increase in liquidity since 2018, and those interest rates have been fairly steady. And now with options markets, really increasing in depth, I actually think this is a 5 to 10 year trade. Now, 5 to 10 year trade is another economic cycle, right? So people can be earning yield on these assets and dollars and Bitcoin in a delta neutral fashion for 5 to 10 years. That's a whole, you know, what there's going to be like a whole kind of shift in
And
yield products in that time.
what's the magnitude? What's the magnitude of the the APR in that, if realistically over 5 to 10 years?
Yep. So at the moment on the basis trade, the guys that unleveraged are doing 15 to 20% a year. So they're borrowing. We're borrowing US dollars from you at 6% or 7% or 8%, and we're earning 15%. When you add leverage, all of a sudden you're really jacking it up. So then I borrow dollars from you at 6%. I leverage it at 3 to 1. I'm doing 40, 50% a year, right, on the basis trade. So, it's basically you and I without a bank in between, right? So it's more pure market lending rates and borrow rates. And in 5 to 10 years, how will that continue? I think the basis will probably increase, but the yields will stay the same for that trade. And the reason is the CME has a risk premium because you have to fund in cash, and there's not much cross margining going on at the moment. So I won't get too deep into this, but basically capital efficiency is a real challenge, and it's one we're actually trying to solve as a business at the moment. But if you have to fund on the CME and you have to cross margin your Bitcoin on Deribit, fund FTX, that kind of eats up a bit of the yield. So ultimately that'll probably continue into the future. Yields will stay the same, and you'll be able to earn 6-7% in your dollars for 5 to 10 years would be my forecast.
And is that a dollar yield, or am I still taking some Bitcoin or cryptocurrency risk in there?
Mm-hmm. So dollars is like 6 or 7% at the moment on average. So you can lend dollars, but you can also lend Bitcoin and Ethereum. It's lower yields, but Bitcoin and Ethereum are traditionally used to fund the crypto exchanges and margin. Dollars is used to fund the Chicago Mercantile Exchange in Chicago, right? So the CME for more regulated style trading.
So Tim, when you're talking to people in the market now, and you're going to launch your app soon,
Yep.
Let's talk about your apps in a little bit. What's the pain points that you're addressing when you start the marketing call, and how is it being received, and where's the resistance that you're getting?
Yeah, it's trying to find this initial ideal target market. We kind of have a very good idea where we're at long term, but our initial market is these more casual crypto enthusiasts that have a bit of crypto that want exposure to some yields. We're trying to solve three major pain points. It's the complexity of investing in DeFi, especially yield farming. It's the high gas fees of just the barrier of entry of actually kind of entering into some more sophisticated contracts. It's a bit out of the league for so many. It's overall crypto. At least I initially thought it was kind of anyone could have access to this ecosystem. It used to be transactions were free, right? Like no one. That's like ancient history now. And just all these kind of bad actors in it. So those are the three major kind of pain points that we're, trying to solve. And we're taking this as more of a kind of a fintech approach, right? And just a conservative approach where people can, put money onto our platform, earn yields, and keep money safe. So.
And Jon, from your perspective, again, when you're making a sales call, what pain point are you addressing? And what's the response been from the people who are more conservative and have a legacy investment backgrounds?
Yeah, look, I mean, we're really addressing simplicity and transparency in the space, right? And I think one of the big challenges for credit markets and crypto at the moment, like if you plug your crypto on some of the major platforms, right, whether it be BlockFi, Cred, whichever platform you put it on, you don't actually know where those assets are being lent, right? They could be lent to China, they could be margined on unregulated exchanges. You just don't know. So our credit model is, or yield model for the other way to put it is really around providing hyper transparency to our investors. We've only launched this about a fortnight ago, but we basically have a fund administrator ready to go that's going to be mapping out exactly where assets are, what the leverage use is. Is it on the CME or is it sitting on BitMEX, right? Who are our counterparties? Some of those counterparties will be uncollateralized, but we'll be able to limit that risk. So really, it's just creating transparency for those kind of investors that need it to be able to sell into their board to create investments.
Interesting. Just when you're talking to the legacy money manager, right? Are they concerned about what the underlying asset is, or are they looking at the wrapper that you're presenting?
No, I mean, look, they all want exposure to Bitcoin at the moment, right? And in answer to your question, I guess around the sales call, our pitch right now is there's never been a lower risk time to invest in Bitcoin ever in the history of the asset. Even when Bitcoin, if you think about it at $1, who knows what was going to happen at that point. In 2010, 2011, it was Silk Road, radicals, drugs, everything associated with it. 2015 to 2017, you had the bull run, and then you had the bear market after the ICO boom. At all those points, there were questions around whether it would continue, as an asset at all, really. And now with Fidelity, PayPal, and all the big guys entering the space, there's no doubt that this won't be an allocation point in the next decade, 20 years, 100 years. So when you think about it like that and look at the market cap compared to any other market cap, just makes total sense to own that asset at the moment.
All right. Last question before we get to your guys' companies. Toby, you manage some money and represent some Fortune 500 companies, right? How are they looking at this from a treasury perspective? Not from their business going to blockchain, everyone's going to be blockchain, right? But more from, okay, there's a guy who has to manage money. He's responsible for on his GAAP reports having the best number possible. How is that guy in the corporate world looking at this crypto DeFi world and yield, and how's he interfacing here?
Yeah, so I think the movers have been there's some well-known examples, MicroStrategy, Square, that have been the early movers, and obviously the MicroStrategy CEO has pretty much become an internet celebrity overnight through his putting his entire treasury denominated by Bitcoin, which is pretty brave if you're a US publicly listed company CEO to do that, right? And turns out to have been a bit of a genius move.
I'll tell you, as an American lawyer, it's beyond brave. It's kamikaze admirable.
And I'll give you the exact opposite perspective. It was brilliant because what he did was he basically front ran himself, right?
Yeah.
Knowing
How
that
do you
he
mean,
was
James? Can you
knowing that he was a public company and that he was going to get a lot of exposure, and knowing that was going to create awareness and FOMO, he basically went long and then released his information, which would affect the same market that he was investing in. So basically, I think it was a brilliant move in terms of self-promoting, but also taking advantage of from the difference that he knew he was going to make in the world and how people make investment decisions. Toby,
yeah, but I think those are big outliers, and then I think after that you're going to have a presentation of where does it sit in the portfolio, and that they'll be hearing from people like Jon and allocating. I suspect a lot of these people will go via active or managers in the space, or trading the ETFs and those kind of things, and CME and those kind of things. So they'll just have it. A trade that we've been seeing on that corporate side is some people have ended up with Bitcoin who are kind of realizing maybe we shouldn't have bought Bitcoin, and it's becoming quite a successful part of the portfolio. So a friend of mine came up with a trade where he was basically one of the reasons why all of the listed entities are trading at significant premiums. The argument is basically there's this sort of weight of capital in the institutional corporate world that really don't know if they're really allowed to hold Bitcoin. And some of them did buy it back in the day and are trading back, but even more of them are buying into these kind of things. And it's kind of crazy, right? Because Grayscale or whatever, at some points in the last month was trading at like a 17% premium. And the only reason for that is because there's a whole bunch of buying power that doesn't quite feel comfortable being Michael Saylor and turning their entire portfolio into Bitcoin. And so
that premium has been around for a while. I mean, it's people that come to me and say, should I buy on Grayscale? I say to myself, if you can't figure out how to do a wallet, it's an approximation, but the cost of doing that is very significant, right? That intermediary is not free in the Grayscale situation. There's been times when Ethereum was trading at 2x or something like that. It's ridiculous premiums. Jon, talk to me about what you're doing. Talk to me about Zerocap. What is Zerocap, and why would someone be interested in the platform?
Yeah, man. So we're a wealth management firm, and as I mentioned earlier, we focus on sophisticated investors, family offices, and institutions. Our whole kind of approach has been taking my FX background and creating really deep liquidity for these guys. So, we can clear $20 million trade in one hit, which is valuable for these institutions that when they want to pull the trigger, right, they can pull it on the spot. As part of this, we offer insured custody. We've just launched our yield product. So credit products in the markets, earning interest on US dollars, Tether, Bitcoin, and Ethereum. And we also offer some prime services as well, right? So we do some market making on exchanges. We do some prop trading. And really together, it kind of forms, what you'd call almost a bank in a way. But the difference being is we try and run as nimble as we can. We've got a small team of 15 of us that's growing fairly quickly. And we're very interested in having more and more conversations with wealth managers in the space, retirement funds, and really trying to build out our product for that market.
Cool. Tim, what's yield, and why would it be interesting to me?
Yeah, absolutely. So we're building a digital banking platform for DeFi. Our long-term plan is to build a digital bank. This would be my third digital bank that I've built, and we want to build a place where both with fiat and crypto wallets, and where people can actually get access to kind of DeFi investments through kind of a more safe and regulated environment, and kind of get access to this kind of emerging asset class. So, we're launching here in about mid-December, and we kind of testing it in beta mode right now, and we're moving quickly to market. So, be appreciative for any feedback we get.
So basically, Jon and Tim and Toby, I'll get you in a sec. You're both basically building slightly different approaches, but what you're trying to do is go to the guy who wants to get these yields but doesn't want to deal with MetaMask or with wallets and crypto. Are you offering classic protections like deposit insurance or transaction insurance? Why is this? How is this different? Other than being simpler, I get that. How is this different in the risk that I'm taking and the experience that I'm having from going on to Uniswap or whatever?
Yeah, absolutely. So on our side, like we do initially, we're underwriting the entire kind of fund from the company as a kind of pledge to do this. So we're taking 1% of kind of all fees coming off the platform and building an insurance pool, which we have desires to build an insurance product. So we're trying to take a very diversified approach where, and we don't invest into kind of risky asset classes. We got an entire kind of checklist of things that have to pass before we even consider investing part of the portfolio into this. So
sorry, keep answering James's question, but add in there what he said. Is there any sort of insurance or risk reducing techniques that will take a risky asset and make it appropriate so that it nonetheless fits into your slot? And then keep on answering his question.
Yeah, so I mean, our kind of to take an overview on what we're doing, we have our social analysts or our business analysts or our technical and business due diligence. So everything from complete smart contract auditing internally and externally with kind of various partners. And where we're kind of ultimately deploying our assets is where, well, to be very frank, like we don't deploy any capital where we wouldn't deploy our own capital. So on a personal level. Mm-hmm. So it got an entire kind of checklist. It's more kind of, this has been constructed more like a kind of a traditional kind of fund approach, and we give multiple oversight on on everything that we do.
James.
Toby, talk about how you're growing. What's the bread and butter of your business, and where do you see the growth going forward?
Yeah, no. So we're looking at data provision for all of blockchain and other frontier technologies. So be it from sort of enterprise blockchain to crypto DeFi area. I think a lot of attention will be absorbed by understanding the DeFi space. I mean, we're betting heavily on that at the moment. So why we created our calculator, because we felt that we could, it's a tool that you can look at, figure out exactly what kind of returns you could be making on any DeFi pair currently on Uniswap. So and we're just gradually building a whole suite of tools from just the calculator is free, you can go on our website and use it, to other more complex tools that are looking at a more sort of subscription type model. And yeah, we work with people like Hitachi, Barclays, doing a whole bunch of enterprise consultancy. We're helping VC firms diligence the space. I think a new greenfield area that I've been going in sort of DeFi. We started a little small, like I guess, family office at the moment, sort of doing a bit of fund management, and we've been toying with a new kind of breed of DeFi venture capital, which is kind of what gets me excited. Right, I've been in the VC space for 10 years, and I think that the liquidity of crypto is really, really exciting from a tech venture building VC type of view, right? Where effectively you can get the kind of multiples, the beginning of this conversation about the 5-10x. What's interesting is you can get VC type returns on a hedge fund style time frame, right? So you can get 3 to 6 months by seeding these new ideas, which you have a feeling could build a network, and then begin looking at providing liquidity, encouraging these ideas into the market. And some of those ideas will flame out, but many of them will be very, very successful. So that's kind of where we've been toying, and we found what we're quite interested in is as well sort of unloved tokens that have actually built a hell of a lot. And you can just, by giving them a push and reorientating their strategy a bit, you can suddenly get these markets to do very well, these sort of particular projects to really shine. So.
It's interesting because like 3 years ago, I tried to start Crypto Oracle Fund, and the whole purpose of Crypto Oracle was to have daily liquidity in a token that would provide permanent capital inside an investment vehicle, so that basically people could get the upside of the PE/VC investment in the platforms, protocols, exchanges that were coming around. but could have daily liquidity. Because people forget that the liquidity and how an asset is funded is completely unrelated to what the underlying asset is, right? And so what's interesting to investors tends to be the liquidity more than the product. And the liquidity in the crypto world has actually been a false promise up until DeFi has, burped its way along here. It's not yet normalized, but I see that this access to liquidity and the ability to go in and out at your, without penalty, at your discretion, is actually what I think the investors want, right? Yeah. I always, when someone comes to me and says, even when it's just a couple months that you're locked up, to me, that just has a visceral energy that happens where I'm considering it in a different polarized light because I can't get out of it when I want to, right?
Yeah. And the model we've come up with, which I think is quite cool, which is basically the investor locks up something, but they lock up F. So basically, the investor goes, look, we're going to help you create a liquidity pool on this thing. We're going to launch you on Uniswap. But then what we're providing is the investor's F. And then the project to get that investor's F is providing their tokens, which is the currency they have, right? So so the investor starts from day one doubling their money, right, locks up F, but if they're believing in the long-term value of F for 6 months, then they're willing to take that much more than the illiquidity issues of some random project where you don't know.
Well, I think the other interesting thing is here is if you decided you want to stay long and you want to be a hodler, these systems make sense because I want to have the same number of Bitcoin anyway in the future. Why not get a yield for it? Why not? I don't mind in that instance. It's okay. So let's go here. Let's go around the table here and, give the name, how do we find you? How do we find your platform and who should come looking, right? Jon.
Cool, yeah, Jon de Wet. If you go to zerocap.io, you can grab our website there. There's a bunch of interesting research if you're interested in any of the portfolio modeling and things we're doing. We'd love to talk to sophisticated investors, wealth managers, family offices, and perhaps people that want to dip their toes but haven't really had the right access point for lack of a stockbroking type model or prime broker type model where we can really walk you through it and provide those services.
Tim?
You can find us at yield.app, and ultimately the people that we're looking for is just people that want kind of access to DeFi and kind of crypto investments, and we see ourselves as a kind of an easy way to kind of enter the space and more of a passive income.
And my tip of the hat to you for your domain name. That's good.
Thank you, sir.
Toby?
Yeah. Toby Lewis. Our website, www.novuminsights.com. Check out our DeFi calculator there. We can work on any sort of advisory project across the blockchain space. Happy to deal on the VC hedge fund side, and also we work in sort of anything, even touching enterprise blockchain, working with a number of VCs doing due diligence on projects there as well.
James, how do we find you?
Oh my God, I was gonna hand it to you first because you're always so gracious, Gordon. So I'm James Haft. I'm at PALcapital, so PALcapital.com. We focus on creating liquidity strategies for people investing in emerging markets assets. For the last 20 years, I've defined emerging markets as companies that would benefit from the digitization of information. And in the last 5 years, we've defined it exclusively as companies which are benefiting from distributed ledger technology, and specifically the creation of digital money and digital value and digital information, and the homogeneous interchangeability of those assets and the changes that that's making to business and to politics and society. So it's James Haft. I'm JF Haft on every platform on the face of the earth. Thank God there hasn't been a popular JF Haft other than me yet. And it's www.PALcapital.com. Gordon, how about you?
Gordon Einstein. Like I mentioned, I'm a lawyer who specializes in crypto and blockchain, DeFi, DAOs, all that other groundbreaking stuff. I love this area so much that I had stopped practicing law and went back into law in order to practice in this area. So I'm like a convict who was returned to a beautiful prison, and I'm very happy about it. I don't know if that analogy works, but hopefully you get my meaning.
It's a gilded cage. It's a gilded cage.
It's beautiful. Well, you know what? I've been in worse. It's okay. This is good. CryptoLawPartners.com. But I think like most of these people, I'm all over social media as well. So just reach out, and I'm always, whether you have a legal issue or not, I just like hearing about cool stuff. I'm in this area because it's cool.
You're the online. You're the other Einstein. That's how I look at it. Exactly. All right, guys. Thank you so much. I really appreciate it, and look forward to seeing all you guys next week at DLT Fridays.
Yep. Episode number 4.
Exactly.
Thanks, gang.
Thanks, everyone.
Appreciate
Really appreciate
it.
it.
All right, thanks.
Cheers.
Thanks, James. Thanks, Gordon.
Bye, guys.